Now I would like to welcome to the stage Mr. David Wright, Secretary General of the International Organization of Securities Commission. After his speech, Mr. Wright will be happy to answer your questions, and Mr. Jalil Tarif, the Secretary General of the Union of Arab Securities Authorities, will moderate the Q&A session. Mr.
Wright. Excellencies, distinguished guests, I'm really delighted to be here, here in Dubai for the first Arab Capital Markets Conference. In fact, I really wanted to be here. It's a pleasure for me to see many IOSCO members here, chairmen, CEOs, and thank you for your very warm welcome. And let me also thank the Union of Arab Securities Authorities, the Securities and Commodities Authority, the Arab Monetary Fund, and other partners, and of course Thomson Reuters for this excellent initiative. I was very attracted to come here because the subject matter, both of them are very close to my heart. Capital markets, the integration of capital markets, and also integration as a whole. I like the duality of the subject matter. They are linked together. Are they not? And I think capital markets and integration into global, regional levels will become increasingly so as the years advance all around the world. We all know that the world is interconnected today, and the depth of those links, human, capital, goods, services, and so forth, will deepen over time, will they not? It's really inconceivable to me that we won't see a more deeper interconnected world in the years ahead. There are a few countries, of course, we know who prefer splendid isolation, cut themselves off from the rest of the world. Sooner or later, that will change as well. They will change. Just as a wall that separated East and West Berlin fell under the pressure of freedom and the people. Excuse me today making a few reflections about integration because I worked in the European Union for 34 years, and that was really the heart of what the European Union was about. And by integrating, whether it's capital markets or services markets or political integration, there are tremendous benefits. And sometimes I think we tend to forget them. There are scale economies. It increases competition and choice, and it encourages innovation as competition increases. It builds links in a political and security sense. It builds friendships, actually. I always used to look around the room when I was chairing a dreadful meeting in Brussels and see 27 member states arguing about everything. And my team would be very depressed at the end of the day. But I wasn't. I used to say, look, we're in the same room and we're all here and we're trying to make progress. We won't make progress every day, but usually you do. So I never got depressed about us not making progress. I would get very depressed if we weren't in the same room trying to find our common interests and moving forward. Integration builds cultural and social understanding. I saw that very strongly in Europe. It builds mutual respect among countries. And most importantly, in the widest sense, it builds peace. And the European Union, there's a lot wrong with the European Union today. We can see that in the newspapers, the economy is doing badly, and so forth. But the cost of the European Union for the member states is 1% of GDP. That's 1% of gross domestic product is the budgetary cost. And I think that's cheap. I think that's extraordinarily cheap for 28 countries who have lived in peace in Europe since 1945. I don't think you can find anything cheaper on the supermarket shelf. Capital markets have to develop and integrate around the world if we want to finance sustainably the global economy, your economies. And what's happening? Well, the capital in the banking system, the Basel agreements, is ramping up capital very considerably, 7 or 8 times more capital in the banking system required today under the basic rules. And you will have seen in the G20 at the Brisbane Summit of Heads of State about 2 weeks ago, that even more capital is being required of the G-SIFIs, the big ones, and some banks, some international banks who are in that category think that the capital levels could be as high as 23% risk-weighted assets, 23%. So that means there's going to be a shift to the financing in some people call this the shadow banking sector. In IOSCO, we prefer to talk about market-based financing instruments. And this is already growing very strongly. If you look at the FSB's work, you will see that so-called shadow banking, the word we don't like, but it's growing at about 7% a year at a global level. 40% of the banking system in value terms today, $75 trillion of business. Now, I think another thing is happening as well, and I think this is a very interesting trend, and I think more and more people, and I suspect listening to the debates this morning, more and more people and regulators and finance ministers, countries, understand that having a very plural system of financing the economy is a good thing. You don't want to put all your eggs into one basket. In Europe, 2/3 of the financing of the economy today is in the banking system. Well, if you ramp up capital in the banking system, there's only 1/3 left to finance the economy, and that is why Europe is moving strongly in favor of what they call a capital markets union, exactly what you're talking about here this morning. In the US, the banking system is much smaller in relative terms, 1/3 of the financing system in the United States. But the advantage, it seems to me, in the US is that there's a lot of other options to finance: the bond and equity markets, the derivatives markets, an effective venture capital, seed, startup type of capital, crowdfunding to a smaller extent. Securitization, I'm talking about good securitization, not the rubbish that was so disastrous in this financial crisis, the subprime. Long-term financing for infrastructures, we all need that. There are massive, massive long-term financing needs for infrastructure today. And if you read the Brisbane G20 heads of state and government, it's right through all of the statement is the need to find capital, patient long-term capital, to develop infrastructure around the world. We need strong asset managers, strong investment funds, strong insurance and pension funds, and absolutely first-class infrastructure, both the payment systems and, of course, the clearing and settlement system for transactions. And some people are getting a little bit worried about the shift of risk into the clearing system, and particularly, of course, derivatives. And of course, all markets need local instruments, whether it's Islamic-based financial instruments. That is, in my view, absolutely a good thing. So the more plural the financial system becomes, it seems to me, logically speaking, you have more options one part of the markets might be not doing so well, but there are others that can substitute. So I think this is a growing trend and realization that plurality of finance and integration of finance is a good thing. And also I think there's another factor. And the other factor is, particularly in emerging market countries, a strong feeling that no longer can they depend on the whims and of international capital provided through the global banking system. That money's there one minute, things get bad, it goes. And I can remember very clearly a major bank, listening to the chairman of a major bank, almost trying to gain favors with his finance minister by saying, "You see, I took all my money back in order to protect the capital in his domestic market." So that dependence on rather volatile international capital flows is decreasing. Now we in IOSCO, we bring together all the world's securities regulators. We are very involved in trying to make the financial system safer and more stable after this catastrophic financial crisis. You know, nobody quite knows how much this has cost, but just to give you one example, in Europe, European economic activity has still not got back to the level prior to the crisis. So that effectively means it's 7 years of lost growth, 7 years of famine. That's what, 10, 15% of GDP, and that's the sort of number I often hear. So what do we need? Well, we clearly need prudentially sound rules that are effectively enforced, with strong sanctions regimes, effective deterrence. People who abuse markets have got to know that the rule of law is going to pick them up and, in the worst offenses, in my view, hoist them off to jail. We need strong capital levels. We need resolution frameworks that are going to work, particularly on a cross-border basis. And we need to ensure that the derivatives markets are really much safer, traded more on exchange, cleared through the clearing system, and reported to trade repositories. And as we've been hearing, we need strong market conduct rules that protect consumers effectively, fairly, honestly, as Abe Ote was saying, effective financial education to ensure effective financial inclusion. That's absolutely essential. You can't have a market without those basic principles. And at the same time, you've got to have financial institutions in those markets who behave. And what we've seen recently just beggars belief. We have seen some of the most atrocious behavior of some firms in financial markets that I can ever remember. Manipulation of the fundamental benchmarks of financial markets around the world, the IBORs, manipulation of Forex, manipulation of some commodity markets. It's unbelievable. How can you have a global financial system that's got to do this job of financing the economy if this sort of stuff is going to go on? And what happens is that all the pressure then comes on to the regulators, doesn't matter where they are, do something about it, get tougher, make the conduct rules even tougher. And that's maybe not what the market needs to develop. But you can see all the pressures that can build up. We also need very good research. And we need the best brains to look at what's going on in capital markets. This is complicated. We need to put together and share our views about emerging dangers. Often these dangers come through property markets, but not always. We want to watch very carefully what is happening across the radar screen. So tomorrow's risks are not going to be like today's. And in IOSCO, we're getting worried about things like cybercrime. We don't think audit quality is good enough. What is digital disruption going to do to the financial industry? You can buy, and you will be able to buy and sell on the iPhone all your investment trust, do all your business on 2 clicks on an iPhone. What does this mean for investor protection? How are our regulators, securities regulators, going to be able to protect the public if it is so easy and so quick to trade? And actually, this will probably result, or could result, in more volatility and pro-cyclicality of markets. We're getting worried a little bit about risk concentration, as I said, in CCPs. We don't quite understand what's going on with collateral. Some people say there's enough collateral, other people say there isn't, and others say the velocity of collateral will simply increase. Who knows? And the point here is that we actually do not have a terribly good understanding of how capital markets function. And so when I heard your debates this morning, I was thinking, we know in the Western world, we haven't done very well about regulating key markets. Don't forget, the banking regulators left the world with less than 3% risk-weighted capital as this crisis took hold, with leverage levels in some cases as high as 80. So we really need a collective effort here to better understand the interlinkages of capital markets. We need better data, and we need our best brains around the table working in the collective public good. An issue that's come up very recently, the disappearance or apparent reduction in market makers, partly due to capital levels being changed, but in stress market conditions, markets that look perfectly liquid normally may not be, because there won't be anybody to make the markets. And of course, everybody worries about what I said earlier about quantitative easing. As it eases off in the United States, what is going to happen in emerging market countries? It also seems to us, I think, that we should try to ensure that we have a financial system that builds long-term patient capital. One of my members, I won't tell you who it is, described Western capital markets as the Wild West. The Wild West. With the wrong incentives, very short term, and that hasn't done too much for the financing of the economy, has it? Because otherwise we wouldn't be talking about long-term financing and the importance of building long-term capital for infrastructure financing. And another thing we ought to all remember, I think, is that finance, important though it is, vital though it is, in economic terms, it's always less than 10% of GDP, often considerably less. So there's 90% of the real economy that we should be really concerned about. So finance has to work for the economy and not the economy for finance. And short-termism can, I think, be quite dangerous. We've seen all the scandals around remuneration, the wrong incentives, pro-cyclicality. We've seen it's useless for financing long-term. And I think what it does as well is that it sort of inflates market intermediation. Money just circulates around, but the real economy does not benefit. Now, in IOSCO, we are very involved, as I said, in much of this work at global level. I would say 40% of our work is working with the Financial Stability Board and the BCBS, the Basel Committee. We're very involved in work on money market funds and cross-border issues, non-bank, non-insurance SIFIs. Who are they systemic? Investment funds, asset managers? We're very involved in trying to improve the functioning of the securitization markets. We are very much in the lead on putting some order on the benchmarking scandals. We have an MMOU in IOSCO, which is a remarkable instrument. Many members here have signed it. 103 countries exchanging information on enforcement cases, on market abuse cases, cooperating among each other. Nothing legal about this, nothing obligatory, but a clear mutual interest to cooperate. And we have over 3,000 exchanges of information a year, and that is growing quite significantly. One of the areas where I feel IOSCO must do much more, and I'm hoping we will start this next year, is on capacity building. I feel we haven't moved as far as we should have done. And one of the things we want to do is to build a really first-class, interactive, online education and training programs covering all the key areas of securities markets, not just the IOSCO principles, but speeches, bibliographies, a really interesting approach to try and help new regulators improve their capacity. So I want to start that next year, and certainly I will need your help to do so. We're working as well on an interesting idea, which is whether IOSCO should branch out and introduce regional hubs. We've had proposals from a number of countries interested in that idea. And if there is if there are regional hubs to be developed in IOSCO, certainly one should be in this region of the world. We're looking forward in IOSCO. We're looking forward to our 2020. What are our big priorities? And the ones that the board of IOSCO seems to be indicating, this is not official, but let me give you some signals here: the cross-border conflicts of law, the non-bank, non-insurance SIFI debate, strengthening the MMOU, the Multilateral Memorandum of Understanding even more, capacity building, I'm very pleased that's right up there, and this 2020 longer-term view. So all of that is our agenda. It's got to be implemented. It's got to be assessed on a continuous basis, and that is why we have a strong implementation committee in IOSCO. We work very closely with the Financial Stability Board, and we need all of us to make sure that once we come to agreements, that we implement them in a broadly convergent way. And here's the problem we've got, is that nothing we do at global level is binding, nothing at all. And so it is a best efforts policy, which a lot of the time works. Sometimes it doesn't. And what do you do when it doesn't? What do you do with a country or a jurisdiction that is trying to maybe seek benefit from regulatory arbitrage? Well, there are no tools in the toolbox. And that is why I believe in the longer term, we are going to have to strengthen the global institutions to have a little bit more pressure in the system to ensure compliance at the global level. So capital markets need rules, well thought out rules, proportionate rules, drawn up in an open way. Everybody should be able to comment on them. The comments should be taken seriously. And then a proportionate result should emerge. And this is never mechanical. It's always judgmental. So you need people in regulatory authorities, it seems to me, of different backgrounds, but who've got good judgment. There's no simple answers. We're always at the frontier. We're always dealing with problems that are new. And so we need that good judgment, people who can weigh the balance of evidence, and it's never very easy to do that. So as you pursue your own integration and cooperation process here, I hope you'll be very bold. I hope you will all work hard to develop your common interests together. I think that the more you do that, the more you will find, I think, that your markets will expand and that investors will become more confident of investing because they will see a common set of rules applicable to everybody. And here's the difficult bit. Exchanging information is fine, but if you really believe in an integrated market, and I believe that is a good thing to aim for, you're going to have some institutions. There are going to have to be institutions that enforce the law. In Europe, there's a court of justice that enforces the European law. You have to define very carefully what the area of responsibility, the areas of competence, and all of that. But I believe that integration is, as I said at the beginning, something of immense benefit. And as I look sadly, very sadly, at what is happening in parts of the world here, integration is the only way forward. As evil hopefully is destroyed, surely we all need to get together, and it needs people of great vision and leadership. It needs people like Nelson Mandela, Aung San Suu Kyi, Jean Monnet from Europe, people who are prepared to take some risks, bring people together, and build a common future. And integration in the end is political, it's economic, it's financial, capital markets, it's social, and it's also cultural. And I think the more we can do that, the world's a better place. Capital markets will do the job according to a set of common rules that you will define, and actually welfare for everybody will increase. Thank you so much.
For his comprehensive speech. We are very happy, first of all, to have you here in this first Arab Capital Market Conference. We are very proud to have the Secretary General of IOSCO, the international leading institution for regulators in the world, to be as a keynote speaker at this first Arab Capital Market Conference. When I first invited Mr. David Wright to participate in this meeting, it was in Luxembourg. It was more than one and a half year ago. And I met him the other time in Rio at 6 o'clock in the morning on the beach, if you remember, right? And I really was very happy to understand his special warm feeling for this region in particular. And this is really appreciated, and we hope really that the relationship with the region, with IOSCO, is also will be a growing relationship. So thank you very much for your time. I know we have really a very tight schedule, and Mr. David also has a flight to catch. So I'll take two very brief questions, and I will give David Wright only for 2 to 3 minutes to respond. So shall I start from here? Kuwait is forthcoming member in IOSCO. Shall we take first question here, and second question will be there. We will take the question together, actually, just for saving the time. But please be very brief. Here, Mr. Al-Saimi.
Thank you. In the earlier part of your speech, you mentioned something, a very important comment about increasing the financing role in the economy of capital markets. You mentioned, I think, Europe being reliant on banking for 2/3 of financing its economy, and I think similar thing is happening in this region. What measures are being taken or at least discussed in Europe in that regard? Thank you.
Thank you. We'll have the second question.
Riyad Al-Dugaither, Intelligentsia Risk Consultancy. Thank you, Mr. Wright, for your comprehensive comments. You mentioned that about 40% of IOSCO's work is involved with the dealings with the BCBS and the Basel Committee, etc. And I would just have a question about post-financial crisis. Now, there are many reasons, factors that helped to precipitate it, but three key issues I think most agree on is one, the question of shadow banking or especially derivatives which are non-exchange traded, like structured instruments. Two are incentive packages at financial institutions that are not properly risk adjusted. And three, governance, not only at the financial institution level, but also at the regulatory level, because there in some major jurisdictions you have this revolving door situation where one person's once he's a chairman of an SEC or something, and the other time he's chairman of one of the investment banks. So there's this situation that so basically what I want to ask is, in your learned opinion, has enough been done on those three fronts to avert the risk of another financial crisis, a repeat of what happened?
Thank you. Yes, please.
Well, very good questions. Let me start with the last question. System, derivatives. I'll come back to the shadow banking issues. Progress on resolution, not finished, but progress. So I think if you read Governor Carney's, who's the chairman of the Financial Stability Board, his letter to the heads of state, I think it's a very fair description of where we are. A lot of progress, but you never finish. There's still things to do. Now, on shadow banking, so-called shadow banking, we don't like that terminology, but what are the elements of this? Well, it's things like the repo and securities lending markets, it's money market funds, securitization, non-bank, non-insurance SIFIs, the relationship between banks and non-banks. And that, there is quite a lot more to do, no question. We will be coming out at the end of the year with a consultation on non-bank, non-insurance SIFIs, looking at separating actually now the asset managers from the investment fund. What worries me much more about shadow banking, so-called, is do we understand it all? Do we understand it all? Do we understand the interconnectivities, the contagion channels? If we do something to margin requirements on OTC derivatives, what's the impact elsewhere? And there, I think we have a lot to do, frankly speaking. And I've said this for a long time. I think the data we have is still inadequate. And I don't think enough investment is being made to look at some of the underlying economics of these markets and how they function. And just for example, as what I was saying about, will markets clear in stressed conditions if there are no market makers or fewer market makers. So I think we always have to be very, very cautious indeed about these markets, and make sure that we understand them. I remember the distinguished journalist Gillian Tett from the Financial Times, probably one of the best journalists on capital markets, I think anyway. She said, we're spending more money on researching the ice caps in the North and South Poles than we are on trying to understand the financial system. So if there's one piece of advice I would give you here, is make those efforts to understand. You know, in a way, that's what Andy Haldane from the Bank of England says. You know, we should imagine ourselves on the Starship Enterprise, having all the data we need at hand. That's not the case today. So we have a lot more to do in this basic understanding of the stocks and flows of the system. On this question of capital markets and capital markets union and so forth, I think the Europeans will not disclose their hand before next year. I think it's evident that they have to do something on small companies. They have to do something on long-term financing. I think tomorrow, or even today, I think it is, that the President of the Commission will announce a 300 or so billion infrastructure set of projects that are going to be financed, partly the first risky piece being taken by various community funds. So I think that's underway. Now, what else? What else? I would hope that they look at a transferable pension fund, a European pension fund, which you can use from market to market as you change your job. And I've also suggested that that they might want to look at something like a European Alibaba. I mean, Alibaba is interesting because it brings buyers and sellers together, has a rating system involved, and actually for multilingual countries like in Europe, this, it seems to me, could be quite a strong tool, and 23 million Chinese businesses seem to think so. So we need some imaginative things as well. And I'm not sure this old sort of pipeline approach to financing small companies is actually going to do the job in the longer term. I think we need to be more imaginative using the new technologies that we have. Anyway, those are a few ideas, and they're hard at work right now.
So allow me on your behalf to thank Mr. David Wright for his time, and we are really honored to have you with us this morning. Thank you so much.
It's time now we speak of innovation in capital markets. In the next session, our speakers will talk out of the box and share with us their views on non-traditional products and schemes and the opportunities and risks that more innovation will bring to our capital markets. Please welcome to the stage Mr. Nabil Rantisi, Managing Director, Brokerage MENA Corp, who will moderate this session, Mr. Henry Bergstrom, Chairman of Board, Nasdaq OMX Armenia, Mr. Salah Al-Sail, Chairman, Conseil du Marché Financier of Tunisia, Mrs. Rasha Othman, Vice President, Corporate Finance at Markaz, and Mr. Nihal Vora, Chief Regulatory Officer, Bombay Stock Exchange.
Your Excellencies, ladies and gentlemen, good morning. There will be a part that is going to be in Arabic in this panel, so the non-Arabic speakers, please have your headsets ready for that part. This panel will be about the innovation in capital markets. We have with us here Mr. Henry, the Chairman of Board, Nasdaq OMX Armenia. We have on his right Mr. Salah Al-Said, Chairman, Conseil du Marché Financier of Tunisia. On his right, Nihal Vora, Chief Regulatory Officer, Bombay Stock Exchange, and Rasha Othman, Vice President, Corporate Finance, Markaz from Kuwait. There seems to be an inordinate amount of news surrounding the innovation in this industry. Innovation to markets and market structure continues to be debated. Then there are those of us inside the walls looking at low latency thinking. Is that what innovation is supposed to look like? What is needed to be more innovative in capital markets? That is what we will know going forward in this panel discussion. Ladies and gentlemen, we have seen different types of exchanges coming up in the region in the past years, more focused on non-cash equity products. Some exchanges picked up, some did not pick up due to different reasons, we would say. And for the ones who did not pick up, they are definitely in need of some innovation, some creativity to attract more liquidity to the markets. Mr. Henry, what are the innovations which have evolved post the financial crisis in the financial market infrastructure space?
Thanks, Nabil. First of all, I'd like to thank the organizers from dragging me from my home, which is in Finland. We have a very dark period of times, and then we got 10 centimeters of wet snow. So being here in Dubai is a really pleasant moment for me, also personally. What I try to now start with is a bit of a painting the scene for the rest of the panel. And I have 4 areas that I would briefly want to cover. It's about the regulatory impact to the markets, to the financial market infrastructure. When I talk about FMIs, financial market infrastructure, I mean exchanges, CCPs, and then CSDs. The other topic will be competition, which clearly has increased post-crisis and just before that. I will talk about asset classes that have been introduced, pushing banks and custodians to a bit behind the scenes. And finally, about the services and then products that the FMIs are offering globally. So first, the regulatory impact. It's clear that 2008 financial crisis had a huge impact on all of us. The regulations have increased significantly. I could name 20 different regulations that are impacting financial market crisis. The same fly is here when David Wright was doing his speech. Sorry about waving. I still have all the conscience here behind me. And what happens is that actually there is a tsunami, if you allow me using that word, of regulations that impact the financial market infrastructure at the same time, which means that nobody really have a full understanding how they impact to the capital market, to the FMIs, to the strategies, to the competition of the financial market infrastructure. And that is a pain for not only for the FMIs, but also for the banks and custodians to try to find their room in the new era of capital markets. The other one is competition. Obviously, the regulatory impact has, at least from NASDAQ perspective, 2 impacts. One is that it actually creates a lot of new opportunities for the FMIs to introduce new asset classes, such as fixed income market, OTC market, commodities market, FX market. But at the same time, it's a pain because there's a lot of investments needed in the FMIs to comply with the regulations. And that is also impacting to the future of the FMIs. We have seen consolidation. We have seen FMIs withdrawing from the business because they feel that this is not anymore where they can be. The size of investments is so huge that the business is not anymore complying with the needs of the shareholders or stakeholders. It has also pushed the FMIs to look at new types of asset classes. So equities and fixed income were the main products for the exchanges to trade with. Now, fixed income has actually moved a bit further in the value chain where the exchanges are truly competing with the banks, even pushed by the regulators to do so, which of course is a big disappointment from many of the banks. The other asset class is commodities, which we are going to talk a bit later, very interesting topic. And then FX, the currency trading that is coming up, especially in the US and then in Europe, to allow the exchanges to come into a market that was traditionally supported primarily or sometimes even only by the banks. The other thing is that what we have seen is within the framework of competition and new asset classes, a sort of a mix of collaboration and competition between the markets. I think it was 2010 or 11 when so-called MILA markets in the Latin America, Mexico, Peru, Chile, and was it Bolivia? They created a new market, which is called MILA. And similar type of market is now building up in ASEAN area, where Singapore, Malaysia, Indonesia are looking for creating a regional offering. And finally, a very fresh one, which seems to be a success, is the Shanghai-Hong Kong link. Wow, this fly is really trying to make persistent. Me look ridiculous. And it succeeded, sorry about that. And then the final point is the services and products. Interestingly enough, we can see at least 2 exchanges coming up that are actually for the Bitcoin market. That is a very interesting opportunity for exchange business to look at. At the same time, we are moving to also provide services on the post-trade area where CCPs are created, trade repositories are created, and at the same time the discussion about shadow banking, which was not allowed terminology, where stock lending and borrowing market, tripartite deals, repo market are pushing up. And finally, the final touch on the services is the so-called big data, which starts now to evolve, creating new business opportunities for the FMIs to educate the market, to allow the regulators as well to access into big data of capital markets, not only within a market, but from a global or regional perspective as well. So that's, I'm sorry it's a bit lengthy, but I think it summarizes also some of the discussions we are going to have here.
Sure. Mr. Vora, what are the basics of the relationships that should exist between commodities markets and securities markets? And should they have a common platform or not?
So first of all, I would like to thank really the organizers. I'm really happy to be here for the first Arab Capital Markets Conference. As Henry mentioned about the financial crisis has really challenged the paradigm of doing business, especially from a financial market infrastructure standpoint. And also from a regulator standpoint, where there is a lot more accountability which is being demanded from regulators Pre the crisis, regulators could just create regulations without really explaining the need and the intent of those regulations. I think the financial crisis brought in a very interesting aspect or nuance for regulators and for regulators making regulations, is that they need to be more transparent, they need to be more forthcoming in terms of how they are going to and why are they going to put in the regulations. Now really going on in terms of the commodity exchanges and the securities exchanges, as in every market, commodities and securities play a very, very important part from a GDP standpoint. Commodity, especially in agrarian kind of an economy, it requires that there's a direct linkage with the producers or the farmers trying to sell their produce at the best rates. And secondly, the users or the consumers trying to get the best price. Now really the exchange platform, what it brings into the fore is a transparent way of really disseminating information both from a supplier standpoint and from a consumer standpoint, getting various prices across locations on a single platform. What does that bring in? It brings in transparency. It brings in the efficiency. For example, if there is a surplus in one part of the country and a shortage in another part of the country, the exchange platform helps us to identify these shortages and surpluses and helps the efficient movement of these produces happening from one end to the other. The second most important thing is that from a consumer standpoint, especially from the public distribution system standpoint, where the government would like to give certain SOPs to the lower strata of the society in terms of consuming their daily produce. If that is done through the exchange platform, it will be kind of seen to be fair, perceived to be fair, at the same time being efficient in trying to identify the areas in which it needs to be really pushed into. So the second most important thing is that the distribution system becomes more efficient. Moment you have the middlemen in terms of the commodity distribution system, is going to bring in a kind of opaqueness, as one would call it, into the system, which could lead to price differences. And the third and the last most important from a commodity standpoint is ensuring that once you have a clearing corporation, a CCP concept, the credit risk which is associated with any kind of large transactions gets eliminated, because you have a specialized institution which is really specializing in clearing and settlement. So it would apply the best margining techniques, which would ensure that it is neither over margin or under margin. And the second more important thing is that there will be a settlement guarantee which would be provided. That brings in a lot of confidence into the system, where a lot more producers and consumers are willing to put in their stake in ensuring that their needs are met. So there is a kind of a convergence which is happening between the securities market and the commodities market. There are certain challenges in commodities market because it's physically settled, it's not cash settled like most securities market instruments. But at the same time, it brings in the inherent advantages of transparency, safety, settlement guarantee into its fold. Thank you.
Thank you, Nihal. So this brings us to another topic regarding the specialty products that could probably help capital markets. As they are in stress in many countries, exchanges, they compete with each other to generate trading volumes, especially those of equities. There should be some innovative work in specialty products to fill some gaps. So Henry, what innovations Postrade can bring to increase exchange companies' revenues and profitability?
Yeah, that's actually quite interesting bullet point, because what we have seen, for example, in NASDAQ, I mean, if I say NASDAQ to you guys, I think the first reflection to you would be the stock market in the US. Now, when we look at what NASDAQ is today, the stock market, I mean, we have 21 markets globally that we operate, but the combined revenue stream we get from the stock market is not more than 15%, 1-5. So NASDAQ as a brand is not anymore about operating and owning stock market. We are a totally different company now. And that reflects also our ambitions, and hopefully we see that that is a good strategy for the other exchange industry or FMIs to look for. One area that we have put a lot of effort and a lot of investments into is actually the post-trade. And I have a fancy of post-trade, so I may be a bit weird, but that's what I really look for. And what I'm referring to is that post-trade is an area where there are a lot of untapped opportunities, business opportunities that can be creating new revenue sources for the FMIs. If we look again a bit from the global perspective, where we had IOSCO, David Wright talking about regulations. There is a specific forum which was CPSS earlier, now it's called CPMI, which does the policy or recommendation for the post-trade industry. We also have standards, market practices that have been globally agreed. And in Europe, we have two specific things, which is the T2S, looking at creating a single European market by introducing cross-border DVP between the European countries, as well as the CSDR, which is very fresh and new, which actually creates a new competitive landscape in Europe. So all those globally and Europe-wise are creating new opportunities for the financial market infrastructure. And if you look at the CCPs, I'm just recently in Gulf, but also in Arab countries, a lot of discussions are ongoing to create a CCP. Derivatives may be something that is pushed a bit further, but for the cash market, you may argue that there's no need for CCP because of the current way settlement takes place, which is on a NIN base and on DVP, and you have a guarantee actually to deliver because of the pre-funding or pre-positioning. However, there is a increased attention into certain type of services that the post-trade community could offer, for example, stock lending and borrowing, facilitating tri-party agreements, repos, for example, and the collateral management of the counterparties in the capital market. And to be efficient on that, you actually need a central counterparty who takes the risk, steps in the middle of that specific trade, and secures that the settlement and clearing takes place on time and a robust way. And that's a new opportunity. That's a business opportunity. It creates new services and products into the market, which obviously are things that exchange industry in the Arab countries are looking for. Further, there is an issue of the CSD. Often we look only for the new revenue streams. At the same time, we could look at the efficiencies that the current structures are actually offering to the market. And one of the areas which I constantly hear is that the liquidity is actually stuck into the current way post-trade is serving the market. And liquidity, increased liquidity, and the opportunities from the post-trade to allow the liquidity to move around between the asset classes and move around in the bank's assets and the businesses is very important. And currently that is not fully leveraged in Arab countries because the liquidity is stuck in the DVP settlement for sometimes longer period of time. And there are new ways of actually efficiently manage the liquidity, which may increase the efficiency of the capital market and offer new solutions.
Henry, I know you spoke a little bit about the Arab capital markets, but do you think that there is a structure where Arab capital markets need to manage to create these specialty products that suits the exchanges in this part of the world?
Yeah, actually, I already answered pretty much
Yes,
the question
so-
when I looked at the new product and the creation of the CCP.
So you think that the same method that was applied probably in the West could be applied in the region? It doesn't need lots of alteration to suit our exchanges and our markets?
Exactly, I would say so. Obviously, if we talk about derivatives, that may be a different issue because of the local
Yes.
regulations and Sharia, etc. But on the other side, what is missing, obviously, is the regulations that support this new type of business and the structures of the markets.
So you think, sorry to interrupt, you think regulators need to react more to these requirements to push forward?
For sure.
Are they doing enough, or they need to do more in this part of the world to get these specialty products in place?
Yeah, I definitely